I ever show you this? How to buy a home if you're self-employed. What are your options? Let's say you want to buy a home and you've been self-employed for 10 years. And in this market and this economy, your business is fluctuating up and down and you have a lot of expenses. You run a lot of home expenses through your business because it's a home-based business. You have some type of service business. And so your income is all showing on your tax return, and gross receipts are, say, maybe $180,000 a year. So your business is bringing in a lot of money, but your expenses to operate that business are exceeding a number that makes it difficult to qualify on your tax returns. So there are loan programs for self-employed borrowers that would fall in the non-qualified mortgage section. And what we would do is we would take your bank statements for the last 12 months. We'd add up all of the deposits. We'd divide by 12. And if you own 100% of the business, we would give you that figure for your gross income. We then apply an expense factor to it. We would start with 50%. Let's say you make $100,000 a month, $1.2 million a year. We would divide that figure in half automatically by 50%. We'd give you a $600,000 number. We then would divide that number by 12. That would be $50,000 a month. I realize that's a hypothetical example and not everybody's making $1 million a year. So whatever that number is, look at your bank statements. You would subtract out any wire transfers or any account transfers, wire transfers, like from one of your accounts to another, or a bank transfer from one of your accounts to your another. If it's a wire incoming, that would be income as long as you can prove that it's income. So we would ask for some invoices to support all of your deposits. And whatever looks like it's income that you can support on your bank account, we give you credit for all of those deposits over a rolling 12-month period. And then we divide that by 12 and divide that by the expense factor, which we just said was 50%. So look at your bank statements, add up all of your deposits. Just go into Microsoft Excel and add them up, January, February, March, all the way through December. You want to look at the last 12 months. So in our case, since we are now in April of 2026, we would look at May of 2025, or we would look at April of 2025 through March of 2026. And we would add up all of that income on your bank account and divide by 12. That gives you a monthly figure. We then apply the expense factor to it. So go take a look at your deposits, add them all up in Microsoft Excel or in Google Sheets or whatever program that you have that adds it all up. Do it by paper, whatever. Take that total number, kick out any deposits that you cannot confirm were income, kick out any transfers from a bank account, like let's say you Zelled from your personal account to your business account yourself because you wanted to make some business payment. That doesn't count as income because that's just you contributing money to the business. Let's say you sold some investment account where you had $20,000 and you needed to put money into the business. Well, you can't take a cash withdrawal from your 401k and deposit in your business and call that income. It's whatever we can prove as income. We then apply the expense factor and we divide that figure by 12. And whatever that number is, that's the number that we use to qualify. Now, every situation is the same formula for qualifying. Credit, income, assets. We just got done talking about that. I feel like we need to talk about this every time. So you always have those three things. It's almost like a three-legged stool. You got to have all three legs or a three-legged stool will not stand up. You got to have all three legs in order to qualify for a mortgage to buy a home or refinance. You have to have the income, you have to have the credit, and you have to have the assets. If you're a homeowner already and you're looking to refinance, you have to have some reserve assets, but you have to have some equity in your home, which is the most important thing. If it's a purchase, the equity is your down payment in the form of cash. So, you must have a satisfactory credit score, and the credit score is dependent on the loan program that we're doing. You must have a sufficient income record when we do your calculation, and of course you must have some down payment if it is a purchase. If it is a refinance, you must have some equity. We can make a loan to you up to 50% on a debt to income ratio. What that means is your principal, interest, taxes, insurance, homeowners association, whatever that number is for your monthly house payment, plus all of your other debt, which is the minimum payments on your credit cards, car loans, student loans, whatever that number is. We add those two numbers together, and your income must be twice that, or your debt can be no more than 50% of your gross monthly income. And we just did the calculation for your gross monthly income. We added up all the deposits, we divided by 12, and then we cut it in half for the expense factor. If your expenses are only 20%, well, we can give you 80% of that number. That's the ceiling. We can go up to 80. We can't say you have no expenses. We can't say you have 10%. It's got to be somewhat acceptable. The threshold is up to 80 is the max we can do. So add up all your deposits, divide by 12, cut it in half by 2 conservatively, that is a 50% expense factor, and then divide that figure by 12, that is your monthly income. Get out your mortgage calculator, calculate what the principal interest or the interest only payment is on your mortgage, add your monthly taxes, your monthly insurance, your monthly homeowners association, and then all the other debt on your credit report. Add that figure together, and your income must be monthly twice this total number. Or the other way to look at it is your monthly expenses must be no more than 50% of your monthly income. So if those deposits exceed that number, you qualify for a mortgage. You only need to have at least a 640 credit score today to have a really good chance to get one of those loans using your bank statements. There are some places that we can do for you all the way down to, I believe, as low as 600. Most people that are buying homes, though, are working on fixing their credit, and we're going to talk about later, how do you fix your credit, right? How do you get a lower interest rate? When you're a self-employed borrower and you're trying to finance a home, obviously we want lower interest. So the way we get lower interest is either 1, you have a higher credit score. 2, you have more down payment or more equity, right? And 3, it depends on the type of loan that we get you qualified for, whether it's a primary residence, whether it's investment property, who we sell the loan to. If it's sold to an insurance company, it's probably going to have a slightly better price for loans for self-employed. So that's how you do that. If you'd like to know more, talk to LendingMan. This is all I have done for nearly 30 years. So let's get started. Give us a call. Let's make it happen. All right?